And altogether, this gives us for the price prediction a price per share of around. In the past 6 months, Grab stock has performed incredibly well, with the stock being up about 42%. But this has many investors wondering if there's still value left in the company. To answer this question, I'm going to provide you with my price prediction and analysis of this company. The first thing to note about Grab stock is the fact that the company just released their 2024 financial statements. So as you can see, the revenue growth was phenomenal considering the trajectory of the company so far. And then the other thing that's really special is the fact that their gross margins are drastically improving, especially for a business of this type. But most importantly, for me personally, one of the things that really stood out is that for the first time in 2024, the company became free cash flow positive, which means that it no longer has to incur losses to continue its growth. But it is still important to note that the company is not profitable yet, as you can see, even though now they're getting pretty close. And also that the company has had a history of issuing more shares, so having shareholder dilution in order to fund its growth and its current operations. And the fact that the company is now emphasizing becoming profitable a lot sooner than perhaps a lot of people were expecting means that the revenue growth moving forward is not likely to be as high as it was in the past. Moving forward, what is going to become very important for the company is to take advantage of this. So as you can see right now, the company reported an increase. Before they had 35 million members in 2024. Now they have 41.3 million members. So this is a great increase. And this is an increase that represents a huge opportunity because as you can see, the company is adding more and more services that all of these different users can take advantage on the app. So as you can see on the consumer side, we have all these different services that you can see across multiple different segments. It is worth noting though that deliveries, it is one of their main revenue drivers as well as financial services. But as you can see, there's different services that are enabled for different customer segments. And the beauty about GrabStock is that it really follows a network system. Think of it kind of like Amazon, where the more products the company has and the more money the company generates, the better sourcing of products they can have, the faster they can ship products, etc., etc. And in this case, Grab follows a very similar ecosystem where the more revenue they're able to generate from all these different sources of revenue, the more the company is able to incentivize drivers, for example, for their delivery service. They can also incentivize more merchants to be able to jump onto their platform and even launch new services like advertising, etc. So this really just strengthens the competitive advantage of the company in a market that's growing at a very fast pace. But there's one thing about this that I wish was a little bit different. I wouldn't quite spoil yet the CEO reveal that's a little bit concerning. You can just listen to yourself and then we'll talk about it after.
Worry about giving away competitive secrets to the CEOs of the big ride hailers in other countries?
No, there's a non-compete, so they wouldn't compete with us as long as they're shareholders. So,
and you have no plans to expand outside of Southeast Asia?
No, focused in Southeast Asia.
And yet, you do have offices in Seattle.
That's right. You just heard from the company CEO, which by the way, I think is a really good CEO to have for the company. The company is not expected to expand beyond Southeast Asia, at least for now, which I think could be a really missed opportunity and something that perhaps many shareholders would want in order to reignite even more growth. So we'll see how that pans out for the company, but this is something very important to mention and something important for you to keep in mind, so that way you don't expect any other kind of additional growth from expansions geographically. Something great about the company is the fact that they're really focusing on two key segments that have a lot of expected growth in the future. So number one is deliveries. This currently makes, as you can see, 51% of the revenues. And then number two, right now, this is not making a big percentage of the revenue, but it's going to become more and more important, is the financial services. So as you can see, this makes up 8% of the revenue, but it's growing at a 9% CAGR per year, and it's doubled ever since the past year. And by the way, all this data comes from the Y-Sheets add-on, in which you can just apply a formula like this and get any kind of data that you want for any kind of public stock. With that being said, let's get to the price prediction and see whether or not there's value left in Grab stock. So as you can see, I have this model right here, and this is using formulas from Y-Sheets to calculate a whole bunch of different metrics. The most important assumptions to keep in mind is the revenue growth, the terminal price to sales, and the discount rate. So in terms of the revenue growth, now that the company is expected to focus, as I said before, more on profitability, these high revenue growth rates are not to be expected anymore. The revenue guidance actually for the next year is somewhere between the 19% mark. So in my case, just to be a little bit more conservative and to align the expectations with the expected market growth, I do think that 14% makes sense. You could also bring it higher. Remember, this is not the revenue growth for 1 year. This is the revenue growth for the projected 5 years in this case. So I think 14% makes sense to be year after year after year. And then the other assumption that's critical is the terminal price to sales ratio. So for this, what I did is I looked at the historical ratio of the company. So as you can see right now on a TTM basis is about 6.49, which I think is quite high, but you can see this has fluctuated over time. Here was 5.5, here 8.5, 5.7, etc. And then you can also calculate this on a quarterly basis using this Y-Sheets formula that you can see right here. So as you can see here, it goes from 5, 5, 4, 5, 5. So as you can see, it's usually somewhere between like 4 to like 6, 6.5. And most importantly, what I did is I looked at the competitors in the space. So we have Grab, we have Uber, we have Didi, which by the way, Uber owns part of Grab. So that is great news because it means that the company does not expect to see any major competitors anytime soon. But anyways, the price to sales ratio relative to the revenue growth, in my opinion, does not make sense. There's companies that have a way lower price to sales ratio and very similar growth levels. So for example, Uber, I actually did an analysis that you should check out. It would be really helpful for you to look at. And by the way, after the analysis, the stock completely took off. But anyways, Uber is one of those companies. We also have Didi, which has even higher growth, but even a lower price to sales ratio. And then you can see there's all kinds of companies here. But overall, I think a 4.5 number makes sense, just being conservative. You could also move it up to like 5 perhaps, and you could also move up the revenue growth, but these are conservative assumptions so that we ensure that we're getting good value and a good potential return. The discount rate, because it's a company that is not profitable and has a very small market capitalization, I assign a 15% discount rate, which I think is pretty reasonable. And altogether, this gives us for the price prediction a price per share of around $3 per share. Currently, using this formula from Y-Sheets, you can see that the stock is trading for $4.78 per share. So this represents a downside percentage of negative 34%. However, I do think that the company has a lot of merit, it has a lot of quality to it, and a lot of really good things going for it. So what I would do is add this stock to your watch list, set up your stock price, and then if the stock price drops beyond this level, then this would be a good time to begin purchasing and getting some shares into this particular company. As always, keep in mind this is not investment advice, so always make sure to do your own research. Let me know in the comments what you're doing about Grab stock, and if you want to see other price prediction videos, check them out on our channel.